looking at the latest news for Applied Digital Corp, ticker symbol APLD. Are we staring at a deeply undervalued AI opportunity? Or is this, a classic retail value trap that's just flashing some very serious sell signals right now?
I mean, it really is the ultimate tug of war right now. You have these operational metrics that look like a rocket ship taking off, and they are paired directly with financial metrics that look like an anchor just dropping straight into the abyss.
Yeah, we are unpacking that exact tension today. So it is April 15th, 2026, and you are joining us for a deep dive into what has to be one of the most polarizing battleground stocks on the market today.
Oh, absolutely. It's wildly divisive.
Right. We are going to look under the hood of Applied Digital's explosive revenue growth, their honestly staggering cash burn, and some highly debated insider selling.
There's a lot to dig through.
For sure. And as we get rolling, just a quick but very firm reminder to you listening, everything we explore today is strictly for educational purposes.
Right, we are analyzing data and market mechanics here, not providing financial advice.
Exactly. Do your own research. And hey, if you enjoy digging into these complexities with us, please like the video, subscribe to our YouTube channel, and absolutely leave your thoughts in the comments. We read them, and we really want to hear your take on this company.
Because there are definitely two very distinct camps forming around this stock right now. Bulls and bears are really digging their heels in.
They really are. So to put the current battlefield into perspective, APLD is currently trading at $30.81. It's down about 2.10% today. So it's hovering reasonably close to its 52-week high of $42.27.
Right, but still a long way off from its 52-week lows, which is important context.
Yeah, exactly. So to really understand the psychology of what is happening here, let's start with the price action. Like, what are buyers and sellers actually doing right now before we even crack open the underlying balance sheet?
Well, the short-term trend is flashing a pretty notable warning sign. Over the last few weeks, the stock actually broke below a rising trend channel.
Which means what exactly for the folks listening?
It means instead of consistently stair-stepping, making higher highs and higher lows, the price action has just started to move horizontally. It is consolidating.
Okay, got it.
However, if you zoom out to the midterm trend, it still appears really bullish because it is trading well above its 200-day simple moving average. And that's sitting way down around $24.60.
Interesting. I look at this chart, and honestly, I think of a sports car revving its engine in neutral.
That's a great way to put it.
Right. Like, it is making an unbelievable amount of noise, but is no longer actually climbing the hill.
Yeah.
And the technical indicators really back up that feeling of noise. We have incredibly high volatility, according to the ATR indicator.
Oh, yeah. The swings are wild.
But the momentum indicators are kind of a mixed bag. The Relative Strength Index, or RSI, is sitting near 50 to 60, which is perfectly neutral. And the MOCD indicator is showing mixed signals, with some platforms actually triggering a sell crossover.
Let's actually define what those indicators are telling us about the human behavior behind the chart, because that revving in neutral analogy is just spot on.
Yeah, break it down for us.
So ATR stands for average true range. It literally measures how wildly the stock swings from its high to its low each and every day. A high ATR just means traders are emotional, right? The price is whipping back and forth.
Whiplash for anyone holding it.
Exactly. And then you have MACD, or moving average convergence divergence. That measures the relationship between a fast-moving trend and a slow-moving trend. When the MACD triggers a sell crossover, it essentially means the immediate gas pedal just lost contact with the engine.
Ah, okay. The momentum just stalled out.
Precisely. The immediate forward thrust is gone.
So here's where I want to push back a little bit on the anxiety surrounding this chart. Because if the stock is still trading above its 5-day, 10-day, 20-day, and 200-day moving averages, which, by the way, most algorithmic trading platforms categorize as a solid, strong buy setup, why is breaking below that one short-term rising trend channel causing traders to sweat so much?
I mean, it really comes down to the psychology of exhaustion.
Exhaustion.
Yeah. Moving averages are trailing indicators, right? They tell you where the stock has been, they act like a breadcrumb trail, but the trend channel tells you what is happening at this exact second.
Right.
So breaking below that rising channel and moving horizontally It signifies a sudden, sharp pause in buyer conviction. The buyers who aggressively drove the price up toward that $42 high are suddenly stepping back.
They're looking at the valuation and asking themselves if they're paying too much.
Exactly. They are blinking.
They're blinking. Wow.
And when you connect that hesitation to the high volatility, those massive daily price swings we talked about, it creates a highly unstable environment.
So traders are just nervously waiting for a catalyst to tip the scales one way or the other.
Exactly. They are watching immediate resistance at $31.92. If the price can break through that ceiling, it signals that buyers have, found their courage again.
But they still face major overhead resistance at $39, and ultimately that 52-week high of $42.27.
Which is a tough ceiling to crack.
And if that courage doesn't return, I assume gravity just takes over.
Pretty much, yeah.
So immediate support is at $29.10. But if that floor gives out, the stronger support zones are significantly lower, right? Down at $24.97 and $21.30.
Yeah, that is a steep, painful drop from where we sit today.
Which naturally leads to the most important question for anyone watching this stock.
Yeah.
What are those buyers seeing that is suddenly making them hesitate? Why pull back when the stock is seemingly doing so well on the surface?
Right. To answer that, we really have to open the ledger. We need to contrast the money flowing into Applied Digital with the absolute flood of money pouring out.
Let's do it. So looking at the income statement for the third quarter of fiscal year 2026, the company posted staggering revenue of $126.6 million.
Which is huge.
It is. That is a 139% increase year over year.
And generating 139% top-line growth is the exact kind of metric that guarantees Wall Street's attention. I mean, it proves they have a product in extremely high demand.
Right. It looks great. But the bottom line tells a completely different story. Despite bringing in that $126 million, they reported a net loss of $100.9 million due to their operating costs.
Yeah, that's a tough pill to swallow.
And when we move to the balance sheet as of May 2025, the tension just gets massive. Total assets sit at a very healthy-sounding $1.87 billion.
Sounds great until you look at the liabilities.
Exactly. Total debt is a massive anchor weighing $702.8 million.
Right.
That translates to a 168% debt-to-equity ratio.
And look, that level of leverage is uncomfortable in any sector, let alone technology, which moves so fast.
And the liquidity metrics are just flashing bright red. Working capital is sitting at minus $127.5 million. Furthermore, their free cash flow has swung to a brutal negative $720.2 million.
Let's actually break down the mechanics of those two specific numbers because they are so crucial to understanding the company's survival right now.
Yeah, please do.
So working capital is essentially a company's financial breathing room. If you take every highly liquid asset they could sell tomorrow and subtract every short-term bill they owe tomorrow, where do they stand?
And for Applied Digital, they are $127.5 million underwater on that exact math.
Right. They owe more in immediate obligations than they have in immediate cash, which is terrifying.
It is. And then there's the negative $720 million in free cash flow. Like, it honestly feels like trying to fill a swimming pool with a fire hose, which is that incredible 139% revenue growth. But the pool has a gaping hole at the bottom, draining $720 million out.
That's a great visual.
Right. With negative working capital and hundreds of millions bleeding out, how does a company even keep the lights on?
Well, we kind of have to expand your swimming pool analogy to understand what the company actually does, because the cash bleed isn't due to, reckless corporate retreats or poor management of office supplies.
Right, it's not frivolous spending.
No, the hole in the pool isn't an accident. They piped that hole themselves because they are actively using that water to mix the concrete for 3 stadium-sized pools next door.
Ah, okay.
That $720 million is heavy capital expenditure. They are building out massive data centers to support high-performance computing, or HPC.
The physical infrastructure required for the whole artificial intelligence boom.
Yes, exactly. You cannot just rent a basic commercial warehouse, plug in some servers, and run advanced AI models.
Because they run too hot, right?
Way too hot. These GPUs require immense power. You need specialized liquid cooling systems, you need reinforced flooring to handle the weight, and you need multi-megawatt power grid contracts just to turn them on.
Wow.
They are essentially trying to build the physical toll roads for the entire artificial intelligence revolution,
Yeah.
and that is just the cost of entry.
So they are basically betting the farm on future demand.
It is the ultimate if you build it, they will come strategy. And to be fair, based on that 139% revenue growth, the customers are absolutely showing up.
Right. The demand is real.
It is real, but building those toll roads places severe, dangerous liquidity pressure on the company today. They have to survive long enough to finish the construction so those data centers can actually start generating positive cash flow.
This incredible gamble on infrastructure completely explains the cash burn. But, it forces us to look at human behavior again.
Always comes back to the humans.
It does. Do the people closest to the company, like the analysts tracking every single move and the executives actually running the business, do they believe the gamble will pay off?
And this specific dynamic is the absolute beating heart of the value trap debate.
Right, let's look at the analysts first. So out of the 11 to 15 major analysts covering APLD, the consensus is surprisingly optimistic.
Very optimistic.
They rated a strong buy to moderate buy. The average price targets are sitting between $42.78 and $50.09, and there is an outlier high price target out there of $97.
I mean, reaching 97 implies more than a 200% upside from today's $30 share price.
Right, and the core argument for those high targets relies on forward-looking valuations. Because if you look at trailing earnings, the company has a negative price-to-earnings ratio.
Yeah, by traditional metrics, it is completely unprofitable and overvalued.
Exactly. But analysts are projecting that if their AI infrastructure is completed and they can hit $40 or more per share in future revenue, the stock is currently a steal.
That represents the purest bull case out there. You are not buying the company as it exists today. You are buying the company it will become in 3 years.
But then we look at the insider trading activity, and it tells a completely different narrative.
It's pretty stark.
It really is. The activity is predominantly selling. Just recently, on April 4, 2026, the CEO, Wes Cummins, sold approximately $2.46 million worth of his shares.
Wow.
And on that exact same day, the CFO, Mohammed Moen, sold about $789,000 in shares. And we have 0 major insider buys reported over the last 3 months.
Which is undeniably a bad optic for retail investors trying to find confidence in the stock.
Right. But wait a second, though. If Wall Street analysts are aggressively telling retail investors this stock could rocket to $50 or even $97, why are the CEO and CFO collectively cashing out over $3 million right now?
It's the million-dollar question.
Literally. Is this the exact mechanism of how retail traders get trapped holding the bag?
Well, to be perfectly objective, we do have to look at the mechanics of executive compensation first.
Okay, fair.
Insider selling can often just be standard profit-taking. Executives receive a huge portion of their salary in stock options. If they want to, buy real estate, pay their taxes, or just diversify their personal wealth, they literally have to sell shares.
Right.
We also need to consider Rule 10b5-1 trading plans.
Okay, explain how those work for the listeners.
So a 10b5-1 plan is a pre-scheduled trading program. To avoid any accusations of insider trading, executives will often set a schedule months or even years in advance. It dictates that a certain number of shares will be sold on a specific date, completely regardless of the stock price.
So those sales on April 4th might have been scheduled back in, 2025.
Exactly. They might have been totally mechanical.
But even if it was pre-scheduled, the timing is incredibly poor.
And that is the crux of the entire issue. Even if the sales are mechanical, doing so during a period of intense liquidity pressure, $100 million net loss, and negative working capital, it is a giant red flag.
It really is.
It brings us back to the definition of a value trap. A value trap occurs when a stock appears cheap relative to its projected future growth, causing all these investors to pile in. But the underlying fundamental rot, the debt, the negative cash flow, eventually catches up and collapses the share price.
So the trap is buying the $97 dream while completely ignoring the reality that the company might not even have the cash to survive until that dream is realized.
Exactly. When the people steering the ship are loading up their lifeboats while simultaneously telling the passengers the ship is about to break speed records, retail investors need to pay very, very close attention.
That is a chilling way to put it. So with the analysts pointing to the stars and the executives taking chips off the table, We need to clearly lay out the ultimate bull and bear cases. Like, where are the actual landmines hidden here?
Well, there's one colossal landmine we haven't even touched on yet, and it actively amplifies both the best case and the worst case scenarios.
Ah, you were talking about the short interest.
Yes.
A staggering 29.83% of the stock's float is currently sold short.
Which is massive.
It is. For anyone newer to market mechanics, that means nearly one-third of all available shares have been borrowed and sold by traders who are actively betting that the company will fail and the price will plummet.
It creates a literal powder keg.
Let's walk through the bull case of the recovery scenario and how that short interest plays a role.
Sure.
The bulls lean heavily on that 139% revenue growth and APLD's prime positioning in the AI sector. In the short term, if the price can break through that $32 resistance level we mentioned earlier, it confirms that buyers are back in control.
Right.
And because 30% of the float is sold short, pushing past 32 could trigger a massive short squeeze.
And we should define the mechanics of a short squeeze, because it is one of the most violent events in the entire stock market.
Yeah, how does that actually work?
So when you short a stock, you borrow shares, sell them, and hope to buy them back later at a lower price so you can pocket the difference.
Simple enough.
But if the stock price goes up, your potential losses are mathematically infinite.
Because a stock can theoretically keep going up forever.
Exactly. You are eventually forced to buy shares at the current market price just to close your position and stop the bleeding. So if 30% of the float starts panicking and scrambling to buy shares at the exact same time, the buying pressure goes exponential.
Wow.
The price just goes vertical.
Which becomes a self-fulfilling prophecy of upward momentum. Good news drops, the shorts panic, they buy to cover, and the price just skyrockets.
Yep. But the bear case is just as severe on the other side.
Right, the continuation's lower. The bears are not looking at the future AI hype, they are staring directly at the balance sheet.
And it's an ugly balance sheet.
Very. They see the net losses, the negative free cash flow, the 168% debt-to-equity ratio, and that consistent insider selling.
Right.
So the short-term bear outlook is that if the stock fails to hold its current level, it drops to test the $25 support line, or worse, that $21.30 level.
And the long-term risk for the bears is the ultimate worst-case scenario. The company simply runs out of cash to service its debt before these incredibly expensive data centers are operational and profitable.
Right.
The music stops before the chairs are in place.
So let me get this straight. Nearly 30% of the market is betting against APLD. If good news drops, we get a squeeze and the stock flies. If liquidity actually dries up, the shorts are proven entirely correct. I mean, it sounds like a coin flip for anyone trying to trade this.
I wouldn't classify it as a coin flip, honestly.
No.
No, because a coin flip implies random chance. What we are looking at here is a highly calculated timeline risk.
Timeline risk. Break that down for me.
Okay, so the long-term perspective, the undeniable secular demand for AI infrastructure is fighting a literal war of attrition against the short-term reality of cash burn.
Okay, I see where you're going.
The danger for everyday retail traders is getting caught in the crossfire of those two timelines.
Getting chopped up in the daily volatility while waiting for the long-term thesis to actually play out.
Precisely. You might be 100% correct that in 5 years, Applied Digital is a $97 stock because their data centers are fully leased by major AI players.
Right.
But if the company is forced to issue millions of new shares next month just to raise cash to survive, your current slice of the pie gets severely diluted.
So your shares become worth less even if the company survives.
Exactly. Or if the debt servicing costs crush their operating margins, the long-term demand thesis doesn't even matter. The institutional bears aren't necessarily betting that AI is a fad. They are looking at the liquidity math and betting the company trips over its own debt before it ever crosses the finish line.
That is fascinating. So, bringing all of these complex threads together, what is the core takeaway for you listening? Applied Digital is the absolute definition of a high-stakes, polarized market asset.
Without a doubt.
On the bullish side of the ledger, it offers an unprecedented 139% top-line growth and prime positioning as a toll collector for the AI boom.
Right.
But that incredible growth is heavily weighed down by a $720 million free cash flow bleed, heavy leverage, and top executives cashing out millions of dollars in equity.
It really is a company attempting to build the architecture of the future, but they are paying for it with cash they barely possess today.
Which leaves us with a pre-provocative thought to wrap up today's deep dive. If Applied Digital's high-wire data center gamble pays off, and they successfully position themselves as the backbone of high-performance computing, those $97 price targets might actually become a reality.
They really could.
But if their cash runway ends before the infrastructure is built, will everyday retail investors be left holding a diluted bag while the executives have already secured their profits?
That is the multi-million-dollar question the market is trying to answer right now.
It truly is. Remember, this deep dive is strictly for educational exploration, not financial advice. We want to hear how you are interpreting this data. Are you buying into the AI infrastructure future, or are you shorting the massive cash burn?
Let us know.
Yeah, drop your bull or bear case in the comments section below, and please don't forget to like the video and subscribe to the channel so you don't miss our next breakdown. Until then, keep digging.